Welcome to today's Explainer. Ever wonder why two people can invest the exact same amount of cash for the exact same number of years, but end up with completely different retirement balances? It's kind of wild, right? We usually blame bad stock picks, or maybe a brutal market crash, or just terrible timing. But honestly, the real culprit is way sneakier and a bit shocking. There is this hidden drain just quietly siphoning off your wealth year after year, and it could literally be eating up to 30% or more of your lifetime savings. And the craziest part? Most of us have no idea we're even paying it. Okay, let's dive into this, because the answer really isn't about who picked the next hot stock or who just got lucky. It almost always comes down to invisible fees. When we're building our long-term wealth, we're trusting that our money is out there working just as hard as we are. But these invisible investment fees, they're just operating silently in the background. They aren't loud like a market crash. They don't make the nightly news. But they are relentless. And figuring out how they work is absolutely crucial. It's your very first step to reclaiming your financial independence.
I want you to picture the classic leaky bucket scenario. Imagine you're carrying this bucket of water to fill up a massive tank, and that tank is your retirement. But with every single step of your journey, a tiny hole in the bottom leaks just a couple of drops. At first, you literally don't notice it. It seems completely insignificant. But man, after walking with that bucket for 30 or 40 years, you've lost a colossal amount of water. Well, that is exactly how investment fees work. A 1% annual fee sounds like nothing, right? Just the buck out of every 100. But we all know investing is powered by the magic of compound growth. Well, fees compound too, just in the opposite direction. So instead of helping your money grow, they force your compound interest to work in reverse, slowly shrinking the principal amount that gets to compound over time.
Section 1, the silent wealth killer. Let's look at how small percentages become huge losses.
To really wrap our heads around this, let's look at the actual math. Imagine a totally standard, very achievable game plan. Let's say you invest $500 every single month for 35 years, and we'll assume you get a solid historical average return of 8%. Now, if you didn't have any fees eating away at your progress, your account would grow to roughly $1.1 million. I mean, boom, you're a millionaire. That sounds fantastic. But remember, fees compound in reverse. So let's see what happens when we drop just a seemingly tiny fee into that exact same scenario. And this brilliantly illustrates the devastating impact of that reverse compounding. Just look at the massive gap in those final numbers. If you pay a total annual fee of just 1.5%, your effective real-world return drops from that sweet 8% down to 6.5%. So, after those same 35 years of diligently saving your $500 a month, your final balance isn't $1.1 million. It's closer to $850,000. Think about that. That is a massive contraction of your wealth, all based on a measly 1.5.
That is $250,000 completely gone. Just let the emotional weight of that number sink in for a second. $250,000 vanishes from your future. And it's not because the stock market crashed, you didn't panic and sell everything. It's simply because fees quietly siphoned away year after year, decade after decade. For a lot of folks out there, they are losing 20%, 30%, or even more of their total potential wealth just because of this silent drain.
Section 2, 5 common hidden fees buried in your documents.
A lot of people think investment fees are going to be super obvious, right? Like getting a big monthly bill in the mail. But sadly, that's rarely the case. So here is your roadmap to the 5 most common villains hiding out in your portfolio. We've got expense ratios, advisor fees, sales loads and commissions, trading costs, which include sneaky things like bid-ask spreads and fund turnover costs from constantly swapping stocks, and finally, administrative and account maintenance fees. Let's quickly break these down one by one so you know exactly what to look for. First up is the expense ratio. If you invest through mutual funds or ETFs, you are paying this fee. Basically, it just covers the fund's management and operating costs. But the difference between funds can be absolutely drastic. Broad passive index funds often charge less than 0.10%. On the flip side, an actively managed fund can easily charge well over 1%.
Now, a 1% difference might sound totally trivial today, but over the span of 30 years, this exact gap is what causes tens or even hundreds of thousands of dollars to leak right out of your retirement bucket. Next, we have advisor fees. Now, let me be clear on this. A really good financial advisor can provide tremendous life-changing value, but you have got to understand exactly how they're getting paid. A lot of advisors charge an assets under management fee, usually around 1% a year. But watch how this scales up. When you have a $500,000 portfolio, you're paying $5,000 a year. But as you grow that wealth to $1 million, suddenly that exact same 1% fee is costing you $10,000 every single year. The bigger your portfolio gets, the vastly more expensive this supposedly fixed fee becomes. So the crucial point is understanding how your money actually enters the market, which brings us to sales loads and commissions. Some investment products carry upfront or back-end commissions. Imagine you're super pumped to invest $10,000, but because of an upfront commission, only $9,500 actually hits your account. That means $500 was stolen from your compounding engine before it even had a single day to grow. Literally, it's money that never even gets the chance to work for you. No way we want that. Section 3. The psychology of ignoring fees. Now, what's really interesting about this slide is how our brains literally have natural blind spots for these costs. As humans, we're completely hardwired to get excited about potential rewards. So when a fund splashes a massive, bold headline advertising a 10% average return, we are all in. We instantly pay attention. But nobody, and I mean literally nobody, gets excited about fees. So when the prospectus buries some boring technical 1.2% expense ratio down on page 47 in tiny print, our eyes just glaze right over it. We fixate entirely on the flashy gains and totally underestimate those small recurring costs. Think about it like those monthly streaming or app subscriptions that you sign up for and then completely forget to use. A few bucks here and there, leaving your checking account just doesn't feel painful in the moment, right? It's totally normal to overlook it. It only becomes a painful realization years later when you actually calculate the enormous total of what you've wasted. Well, investment fees operate on that exact same psychological blind spot, just on a much, much larger scale. Section 4. Protecting your retirement wealth. But here is the fantastic news. You do not have to be a victim of this system once you understand how it works. It's time to stop the leaks in your bucket. There's a really powerful contrast in the world of finance. There is so much chaos that is completely out of your hands. You cannot control stock market crashes, right? You can't control the Federal Reserve's interest rates, and you definitely can't prevent recessions. But you absolutely can control your investment costs. Taking control of your fees is the absolute simplest, most guaranteed way to drastically improve your long-term returns. If two investors have the exact same portfolio, but one pays 1.5% in fees and the other pays 0.15%, that second investor gets to keep significantly more of their own gains every single year. Let's move to and see how this builds into an actionable game plan. Here are your 4 practical steps to secure your wealth. Step 1. Compare those expense ratios. Lower cost funds often outperform expensive ones simply because they leave more of your cash working for you. Step 2. Understand every single fee. Seriously. Ask your broker or advisor, what am I paying? How often? Who exactly receives this fee? Never put your money into a product you don't fully understand. Step 3. Review your retirement accounts annually. Please don't just set it and forget it for 30 years. And step 4, focus on long-term efficiency. Because investing isn't just about maximizing your returns, it is heavily about minimizing your unnecessary costs. This brings us to the core philosophy here at MoneyDoodleLab. And it's simple. Financial freedom isn't just about earning more. It's about keeping more of what you earn. Every single dollar you save by cutting out an unnecessary fee is a dollar that stays fully invested, compounding, multiplying, and working tirelessly to build the future you deserve. Because while markets will inevitably rise and fall, fees are absolutely relentless. They charge you when the market is up, they charge you when it crashes, and they charge you whether you're paying attention or not. So I leave you with this final critical question. Have you checked your bucket for leaks recently? Because the biggest threat to your retirement isn't inflation or bad stock pick. It is the silent drain of hidden fees. I highly encourage you, right after this explainer, go open up those investment statements, pull up those prospectuses, take full control of your financial destiny. You've got this. Thank you so much for learning with us today, and I'll see you in the next explainer.